All right, well, we're ready to resume our session and to take a look a little bit at some of the global markets. And to do that, we have Seth Kleinman, Global Head of Energy Strategies for the Citigroup. He's been with the Citigroup since 2011 as Global Head of Energy Strategies, covering all aspects of global oil and gas markets. His team advises clients, whether corporations, institutional investors, or hedge funds, on energy-related investments across all geographies and time horizons. Prior to Citi's, Seth was head of the oil analysis for Glencore in London, and prior to that worked at Hess Energy Trading in Morgan Stanley in New York City. So please join me in welcoming Seth Kleinman.
Thank you very much. Thanks for having me. I've just rushed here very quickly. I noticed that over the past 10 years when I lived in DC, the food's gotten infinitely better, but the traffic has gotten ungodly worse. All right, this does work. So we're still kind of leaning bearish in terms of oil prices here. Of course, something's got to give because we're materially oversupplied in the market, and something's going to have to change that. And I don't think it's going to have to be on the demand side. I think it's not going to come from the demand side. I think it has to come from the supply side, and prices have to be lower to get that to happen. In terms of the charts up here, what you've seen is a lot of volatility, a lot of people wanting to take big short positions. I feel like in terms of a trading environment, what we have in oil is sort of an exact reverse of what we had in early 2014, where everyone was long. We kind of grind higher, but then you get some bearish headline that indicating some possibility of peace in the Middle East, and we'd come off $3. That's kind of what we've got now. People keep running short positions, but then you get rumors of some kind of stimulus coming out of China, and we spike a couple of bucks. That said, though, we've definitely cleaned up a lot. I would characterize the attitude in the trading community right now as heading towards somewhat agnostic because they keep getting beaten up. But that said, the problem is here's the weekly stocks down here. The problem is that the inventories just go in one direction. They just keep going up and up and up and up. People pay a lot of attention to the U.S. inventory data, which has been flatlining for a while, a little bit to down. But you look ex-U.S., you look at the weekly data you get out of Singapore and Japan, etc. And then the ARA stuff. We just keep building inventories. You look at the market; it's telling you we're materially oversupplied. That's the something that's going to have to get fixed. So the arguments coming into this year, people made a few bullish arguments on oil. Okay, one was that shale was gonna die. Okay, shale isn't dying. Shale's ticking lower, but shale is it's going to be ultimately, it'll come back if prices go up. The bullish argument was that non-OPEC would get hit. Non-OPEC production would get hit. Okay, big oil spends 40 to 50% of their capex on brownfield maintenance, slowing decline rates in mature basins. That's that's taken the bulk of the cuts from all the capex pullback. So the argument is that you'll see this acceleration in decline rates roll over in mature basins, in your North Seas, your Russias, et cetera, et cetera. The problem for those bulls, one of the reasons they've kind of given up, is it just isn't happening. Okay, now it doesn't mean it's not going to happen, but year to date, in terms of actual real time, what we see here, okay, this is the loading data. We just got also some Russian 4Q data. Whether you look at the North Sea, it's robust. Russia's very healthy. China's up year on year. Every good candidate for rolling over refuses to roll over. And then you look seasonally. Yeah, you've got the Saudi crude bird going down. That frees up some crude that they can go on to export. And we're still just heading into global refining turnarounds. So that's going to free up a lot of crude that isn't going to get burnt in refineries. So we still think that from here, things still look kind of bearish. Okay, the real issue here, the real congestion in this market, it's about Asia. Okay, this ultimately, obviously, sitting in this room, people probably have a fairly US-centric view of the world, but honestly, the price of WTI is basically the price of Brent plus the ARB. Okay, WTI is really a derived price. It's not Brent is the global price for crude, and everything hangs off of Brent. And that's where things are getting very congested. And the reason I think that you can have what sort of really drives, because yes, US production is heading lower, but I'm still pretty confident staying bearish because Iran is coming back to this market. Okay, the deal seems to be in place somewhere later this year. So more Iranian barrels are already showing up in the marketplace, but probably somewhere in 1Q of next year, there's going to be an awful lot of oil, roughly 500 million barrels a day, could get up to 1 million barrels a day, including condensate, is going to come to this market, is going to get jammed into the Asian market, and that is becoming an extraordinarily congested market. And the outlet, the overhang of crude that you have now in the Atlantic Basin, okay, the basic dynamics, I think I talked about this last year. U.S. shale production's gone up. It's kicked out all these imports that used to come into the U.S. All that crude is in the Atlantic Basin. You now have a surplus of crude in the Atlantic Basin. The outlet for that crude is Asia. So when the Saudis start slashing prices into Asia, that big cut, that's the price for Saudi crude, OSPs, last year. That's what really triggered this whole decline. When the Saudis started slashing prices in Asia, it basically slammed the exit door shut for this surplus of crude in the Atlantic Basin, and so the curve went into contango, the curve flipped. That's how you created this oversupply for the benchmarks of Brent WTI. And now it feels like even if the Saudis are busy cutting prices again in Asia to defend market share, but now Iran is going to come and dump an awful lot of oil into that market. So where is this surplus crude in the Atlantic Basin going to go? I'm going to talk about Asia a lot because it's really what's driving the dynamics here. One thing that got bulls kind of excited is that there's every indication that Saudis have started pulling back on production. That, at first blush, that seems kind of bullish. You know, less production. It was Saudis ramping up production, trying to defend market share that sort of triggered this whole price collapse, and now they're pulling back. Does that indicate a reevaluation of this market policy? I think not. It may look bullish, but I actually think it's reflecting profoundly bearish fundamentals. Okay, what I mean by that is, so the Saudis, they set their OSPs. Don't really have time to go into how Saudis sell their crude. Most crude is not sold on the screen at spot prices. It's the first week of every month, Saudi Arabia comes out and issues its OSPs, official sales prices. So these prices, they set their prices regional, as differentials to regional benchmarks. So if you're selling crude into the US, it gets set against WTI. So it'll be like WTI +1 or -1.5. They do the same for Asia against Dubai. They do it for Europe against Brent. Okay, now you can kind of look back over how the previous month's trading and kind of figure out fair value for what that OSP should be. So if crude's been really strong and products are strong, they're going to raise prices. It's typically how it's done. It's fairly formulaic. You can figure out a range of fair value. And over the past couple of months, the Saudis set their prices, talking to our traders, talking to a lot of traders in Asia, basically of a range of fair value. They came in right at the bottom. They thought they were being kind of generous. The problem is the Asian refiners then turned around and said, actually, you know what? The Kuwaitis are offering us better terms now. The Nigerians are camped out in Asia. The Mexicans, everyone is trying to push their crude into this increasingly congested Asian market. So the Asian refiners turned around and said, actually, we just want the bare minimums of our contracts. There's a range that you can take. And the Saudi storage is basically full. So the Saudis, no one wanted this extra crude. Their storage is full. So yeah, they had to pull back. So it looks bullish because they're reducing supplies, except it's actually reflecting extremely bearish fundamentals, this extreme congestion in the Asian marketplace. Plus, as their Saudi crude burn goes down seasonally, okay, they burn a lot of oil for power gen in Saudi Arabia, they'll be able to export more of that crude. That'll free up a delta that they can export. And importantly, they just fired up a really big refinery, Yazref refinery, 400,000 barrels a day, came online over the summer. It's geared towards running the really heavy, crappy, sour crude from Saudi. So before the summer, the upgrading units went online, so now they can burn the not very good crude and sell more of the decent crude, their Arab lights, Arab mediums. Part of the unfortunate aspects of my job is having to throw up global balances and quarterly prices. Here they are. We can talk about them if you like, but I don't tend to be a big believer. Citi's base case view is that at some stage over the next year, you start to see non-OPEC production getting hit and prices grind higher as a result. That's our overall view, although the 4Q of this year and 1Q of next year gets hit as Iranian barrels come to market. That's our big picture view of sort of the dynamics underlying the oil markets. Okay, in terms of demand, a lot of people got very excited. Oil prices go down. They think demand's going to go up. I personally don't really understand that as a thesis because, I don't know, people here, clearly in America, gasoline demand is strong. Apparently, you guys are all cruising the strip like it's the 1950s. I didn't think that was really the dynamic at play anymore. I thought it was more of a cell phone generation. But, you know, if you look around the rest of the world, from a macroeconomic standpoint, yeah, lower oil price is good for America. You're still a net energy importer. It's good for China. It's good for India. But it's really bad for Russia, and it's bad for Latin America, and it's bad for Africa, and it's very bad for the Middle East. Now, if you just stack up GDPs, yeah, your consumers, your importers are bigger than your exporters. except that over the past 10 years, a lot of the commodity demand growth, especially in oil, has actually been driven by these exporters. Okay, it never ceases to amaze me as a statistic that the oil demand growth in Saudi Arabia has outpaced that of India consistently. I'm not talking on a percentage basis, I'm talking on an absolute basis. There's 50 million people in Saudi versus 1.3 billion in India. Okay, these oil exporters have been massive drivers, massive beneficiaries of the higher oil price, and massive drivers of the demand growth that we've seen over the past 10, 15 years. And they're getting hit hard here. Plus, the currency, the stronger dollar, means that actually the retail price drop that you see in China and India, some of them you typically have regulated prices, but in a lot of EMs it's much, much smaller. You've got 10-20% drop in retail pricing versus the 50% odd drop that we've got in crude pricing. It doesn't feed through. We can come back to the macro because I think it's pretty interesting. But I should at least note that Willem Buder, Citi's chief economist, he's pretty bearish on things. He does tend to be often quite bearish, but he's got a lot of attention. He's been calling for a north of 50% chance of a global growth recession. Basically, he's very, very worried about the state of macro health across wide swaths of the macro economy. We can go through, we have a big model where we run GDP versus oil demand, country by country, product by product. But spoiler alert, if you have a big slowdown in the global economy, it's bearish crude demand. All right, so right now we're building a lot of products. For the sake of timing, I'm going to jump through this a little bit, but I would say if we're worried about global growth, okay, a lot of things are pointing. This is the Winter Fuels Conference, so winter fuel, I guess the heating oil contract used to be heating oil, now it's more diesel. But either way, as we head into winter, this weakness is very diesel focused. Okay, the macro risks, if you have a sputtering global economy, we see it in 2008, diesel gets hit a lot harder than gasoline. You're already seeing that. If you look in China, the first half of this year, okay, people throw around some crazy numbers, I think, for China, and it is a fairly opaque in terms of data. But you talk to Sinopec, biggest refinery in the country, biggest refining company in the country, they'll say that Chinese oil demand was up about 3% year on year for the first half of the year. Okay, some of that oil demand growth was actually propane, which isn't really oil anymore. It's actually gas that's being exported from the US. But basically, what you see is the consumer side of oil demand, your gasoline, your jet fuel, your petrochemicals, all very healthy. Okay, diesel demand was down 6.5% year on year in July. So you're already seeing this weakness in distillates from a demand standpoint as you see this slowdown in some of the energy-intensive industries and various EMs, whereas gasoline continues to look pretty good. But then bolstering that is the change in fundamentals, which, yeah, I do have some exports there. So look, you see what's happening with Chinese exports. Also, complicated dynamic there because China is launching its own futures contract and they need to give their teapots both import quotas for crude and export quotas for diesel. That's exacerbating this diesel glut that we're getting in Asia now. Asia's getting very long diesel. Middle East with its new refiners is getting very long diesel. The US is very long diesel and it's meeting this weaker macro demand environment. Winter fuels look pretty beautiful, I guess, from a consumer standpoint, but most of the people I talk to are refiners. It looks pretty ugly. They're pretty depressed. That said, I think next year gasoline could be great. Okay, an interesting sort of technical note, you got lots of oil in this country now, shale oil, big bounty. And people used to think that that's going to result in a glut of gasoline, okay, except shale oil is actually fairly highly paraffinic. What that means is that you run it through your refinery, you do get a lot of gasoline, but it's a low-octane gasoline. So you've got to run out and source these high-octane, aromatics, expensive blending components. Typically, you would go and get them from Europe. You used to be in New York Harbor. That's the delivery point for NYMEX gasoline. You would come over to Europe, Pembroke and other refineries, and import these high valuable blending components to raise the octane in the gasoline. That worked great, except for the fact that the good times that the U.S. refiners have had over the past few years have just shuttered vast amounts of refining capacity in Europe. So it's been very, very miserable times in European refining the last few years. We've shut north of 1 million barrels a day of capacity, and part of that capacity that got shut is effectively starving New York Harbor, delivery point for NYMEX gasoline, of these valuable components. So in short, coupled with the good demand that you've got here, you're all cruising the strip. Gasoline, I think, is going to have a very healthy season next year, but distillates look pretty ugly. All right, so we'll come to crude. Crude is really where the action is. So So we talked about demand. I call it something's got to give because we're oversupplied. So S is greater than D. So inventories keep building. Okay. So what's going to fix this situation? Because at some stage we're going to get full everywhere. Okay. Unless we fix this. So I don't think it's going to be demand. I didn't think it was going to be demand initially, and macro environment seems to be worse. So I definitely don't think demand is the answer. So then we come to supply. So you've got basically two buckets of global oil supplies. Okay. You've got OPEC and then you've got non-OPEC. So non-OPEC, you've got shale and non-shale. We already said that so far year to date, there's no sign of this weakness in the non-OPEC, non-shale, but we are seeing shale production declining. Okay, I mean, and obviously EIA is the industry benchmark for looking at that, and using their various data, it does look like shale is heading lower. I've been in Houston most of the last week, and people there are very sad. Clearly production heading lower. Doesn't look like it's going to be bouncing back anytime soon unless the oil price comes back. So shale is heading lower. The problem is that shale is off 300,000 to 400,000 barrels a day, but we're oversupplied by 1 to 2 million barrels a day. Maybe more, but roughly 1 to 2 million barrels a day. So shale, this decline doesn't fix it here. Now, one thing that is happening, okay, one thing that drove this shale production story, it was technology, and it was geology, and it was cheap debt. It was cheap money, okay? These guys have been in Texas. You give someone $1, they'll run out and they'll drill $1.60's worth of wells, okay? Now the capital markets are getting tighter. They're taking away the fund, this cheap money that facilitated these companies from bridging the funding gap. Okay, that bridge is getting shorter. Now you give them $1, they'll go and drill $1.10 or $1.20's worth of wells. So the capital markets tightening is clearly it's getting a lot of attention right now. A lot of discussion about these RBL redeterminations. Anyways, that's just a subset of capital markets tightening for shale. Does that therefore fix the commodity? That's the problem. I think the answer is no. So what this scatter plot here is showing basically how financially stretched you are on the vertical axis. So that's your CapEx versus OPEX ratio. So how much you're spending versus how much is coming in the door versus the volumes, okay? Versus the volumes that you account for. Each dot is a company. The problem, so these guys are in big, big trouble. I'm not going to name any names, but I know who they are. Like, they're in big trouble. They're probably not going to be around in 6 to 12 months. Or 6 weeks in some of their cases. That said, they don't account for any material volume. Okay, and even nestled within these, whereas your investment grade guys down here, you can probably figure out who they are. They're in good shape. Okay, they're actually living within means, basically. They're ever so slightly beyond it, but the capital markets remain sufficiently open if you've got good assets, if you're in the right place, if you're in the Permian, and God bless you if you're in the Wolf Camp, like, you can still raise an awful lot of cash. So the answer, this capital market tightening, it will slow, it will affect the industry. The loan redeterminations that we're going through right now, a lot of news flow on that. That will be a definitive cataclysmic event for some companies, but it's not going to do much. It's not, I think, a particularly big catalyst for the commodity. Because, yeah, look, these guys can go away and you can lose 200,000-300,000 barrels a day of oil, except for the fact that nestled within some of these companies that are in trouble are some decent assets. Those decent assets will continue to produce through bankruptcy, through acquisition, through debt restructuring. Like, even nestled within some of these volumes are some decent assets that aren't going to go away. So let's keep an eye on timing here. So this is not, the capital markets tightening is definitely something to watch, and for some companies it will be a big deal, but it doesn't solve the overhang in terms of the global oil markets. Just sort of as a side note, I think it's interesting that low interest rate environment, easy money, it's supposed to be inflationary. That's the general sort of assumption that underlies that whole monetary stance. And yet, through some of this easy money flowing into the shale space, facilitating these guys living so far beyond their cash flow for so long, it has proven cataclysmically deflationary for oil, and I tend to view most of the commodity complex through oil, gold accepted, and through oil for basically the entire commodity complex and vast swaths of the emerging markets. So I do think that it'll be interesting. It doesn't look like we're about to be leaving a low-interest environment anytime soon, and the estimated time of departure seems to keep getting delayed, but it's notable that it's counterintuitive. It's not what the macroeconomic models predict, and yet it seems pretty undeniable that that's part of the results we've had. So, you can't really come to the EIA without throwing up some of their incredibly useful EIA data. The point is that in terms of the ongoing efficiency gains, they are ongoing, they continue. And what that means is that even if capital markets tighten, okay, so you have a higher cost of capital, it raises your break-evens for these projects, but at the rate of improvements that we continue to see and think will continue for the foreseeable future, it means that even if you double the cost of capital for these companies, as these efficiency gains persist, you basically negate that doubling of the cost of capital in as soon as 12 months. It's actually more like 6 to 18 months, depending on where you are and the type of efficiency gains. So this floor that's coming from shale, it's not floor, I apologize. Ceiling that comes from shale, it kind of keeps inching lower and lower and lower. And then capital can tighten and raise it up, but then it keeps coming back down. So one of the reasons, people want to get bullish on shale, and there's certainly a lot of geopolitical justifications for getting bullish on shale right now, except that I just don't see how you can properly get bullish on oil prices, because shale will come back. It will come back pretty quickly. I mean, when people made this argument that the Saudis were trying to break shale, I mean, in a way, that's actually, I don't think it's wrong, but it's a little bit, it's implying that there's a lack of understanding of oil market dynamics. Again, I don't necessarily think that it's a wrong diagnosis of Saudi behavior, because shale will come up just as quickly as it went down, and probably more quickly. Okay, there's going to be a real asymmetry there. Roughly 80% of the executives at these shale companies, their compensation is tied to volume. It's a volumetric-driven business. They have to grow. That is how they get paid. What that means is that just as we've seen, everyone's been surprised by how slowly volumes of shale production have come down, because the oil rig came down very quickly, and we're just starting to see this delayed, gradual decline in production. If oil prices go back up, I think that will be very asymmetric. I think it will go up much more quickly than it came down, and much more aggressively. So even if you get some event that tightens up the market, we get a bad print in the North Sea, something unpleasant happens in one of the myriad fragile producers now, shale can come up very quickly to fill that gap. So that's why we sort of characterize the oil market expectations as being a series of W's. Yeah, everyone wants to talk about whether it's an L or a U or a V or an X or whatever. I mean, I think you're basically range bound here, because something can come and tighten up this market, and shale will ramp up much more quickly than conventional production. So touched on, you've got demand, we talked about that. Then we come to supply. You've got OPEC and non-OPEC. Okay, so OPEC. OPEC is just going to keep growing production here. I'm really convinced. There's another story today that the deal's in. There's going to be a deal, okay? I was in Singapore a few weeks ago, and Igor Sechin was there. He gave a very clear talk. He tends to speak quite directly. He said, Russia's not going to cut. Russia's not going to cut. We don't do that. We're a privately owned, or a publicly traded company. We're not going to cut. The rig counts in the Middle East, okay, they've never been higher. Okay, you talk to the oil services companies, they're very sad in North America, and they're very sad in Europe, and they're getting sadder they're pretty sad in Asia too. But if you talk to the guys in the Middle East, they're very happy, they're very, very busy, okay, and some of them have never been busier. The oil rig counts in Kuwait, Saudi, UAE, they've never been higher, okay. You don't spend this much money punching this many holes in the ground if you're about to pull back on production. Okay, so I think now what's complicated is it's not inconceivable that they could pull back on production, that Saudis could reevaluate this, but I firmly believe it would be the wrong thing for them to do. That's not a very popular view in Texas, but just in terms of a game theory approach to the realities on the ground now in the oil markets, we have shifted in this world from worries about peak oil supply to worries about peak oil demand. Okay, what that means is that if you're worried about peak oil supply, and there's so many people in India and China, and they're all going to drive cars, so oil demand's going to go up forever and ever and ever, then oil prices kind of have to go along with it. In which case, your optimal extraction strategy for Saudi Arabia is to produce some now and produce more in 10 years, and then more in 20 years, and more in 30 years, okay? Because your oil price looks like that. Now, the market doesn't worry about peak oil supply anymore. In fact, the debate is about peak oil demand. And that transforms Saudi Arabia's very considerable, valuable oil in place from an appreciating resource into a depreciating resource. What that means is that rather than producing some now and more in 10 years and 20 years, you produce it all and you produce it now. Lots of concerns these days about capital getting stranded in the various energy markets as rising concerns about carbon come up. Plenty of concern is also appropriate about stranded oil. Okay, and meanwhile, Iraq just keeps charging ahead, although I think most of the growth, don't think you're going to see too much growth out of Iraq in the next year. So OPEC's just going to keep raising production. And Iran's coming to town. Okay, now Iran matters. Now, I like this chart so much, I'm going to come back to it later in. But so I think this is a very important chart. Okay, what it is showing you is regional oil balances. You can do the same thing for energy balances, where it's oil, gas, and coal. The story is exactly the same, just the numbers are a little bit bigger. Okay, so what it's showing you here is that Middle East is the big surplus. Okay, Middle East is the big long. All right, and with Iran, that number is going to keep going up. It's going to get longer. Then you've got Latin America and Africa. They're longs surplus. Yeah, long is surplus. Okay, then you've got Europe, including FSU. Okay, it used to be short. It used to be a decent short, but because of declining demand over the past 10 years and rising FSU production from Russia and Azerbaijan, Kazakhstan, it's gone. Okay, it's gone. It's out of the market. It's done. Okay, then you've got the North America. Okay, it used to be a very decent short. All right, but because of fracking, it's almost gone. Okay, so what that means is that all you've got left is Asia. So when you hear people talking about market share, the only market that really matters now is Asia. This is all about a fight for market share in Asia. This is why Abu Dhabi sells 5% of itself to INPEX, national energy champion in Japan. Lo and behold, the very next month, for the first time ever, Japan takes more crude from Abu Dhabi than it does from Saudi Arabia. Igor Sechin, he's the CEO of Rosneft, biggest oil company in the world. He was over there in Asia. He just bought an Indian refinery to add to his Chinese refinery collection. Okay, not because those are intrinsically great businesses. It's because you lock down market share. You lock down an outlet for your crude. This is the battle that is on. And now, right now, it is notable that North America's not gone entirely. Okay, it's going to keep going down a bit. You've got upstream reform in Mexico, and you've got Canadian growth from Canadian oil sands that's going to continue for the next few years. So it's going to get closer to being gone. But the Saudis here have a choice, a very clear choice. They can either keep prices low enough that shale basically doesn't grow or shrinks, or they can keep prices low enough such that at least North America remains in play a little bit. Or they can go for higher prices. They could say, we need $70, whatever it is, to get closer to balancing our fiscal budget. In which case, North America's gone. In which case, they're putting all of their chips on Asia. And that might have seemed like a good idea a few years ago, except when you're in Asia, if you look at you go to India, you look at CNBC, 70% of the time you see a solar panel. All they're talking about is renewables. Okay? And there is a lot of LNG heading towards Asia right now. Some of it's going to come from the US, but there's a vast amount of Australian LNG production ramping up, and it's all targeting Asia. Point is, any way you slice or dice it, there are way too many hydrocarbons trying to jam themselves into this increasingly congested market. That's why the Saudis have to pull back on production, because the Asians are in a position to say, actually, there's just better crude, better terms available from all over the world. Everyone's knocking on our door here. So now Iran's going to come back. Now, how quickly can Iran come back next year? We think it's to the tune of 500,000 barrels a day, plus maybe another 200,000 to 300,000 barrels a day of condensate. The condensate can be tough to sell, but it's a byproduct of their gas. And you also see Russia increasingly pivoting to Asia. But the point is that you've got another big chunk of oil that is going to be coming out of Iran on the assumption that the deal progresses, which it clearly seems to be doing, and it's just going to be adding to this extreme congestion in the Asian market. So we talked about this a little bit, about how we haven't seen the declines in, so I keep, all right, 10 minutes. So we haven't seen the declines in non-OPEC as yet. Could happen. A lot of people got excited earlier this year thinking that Russian oil production would roll over, except for the fact that oil prices down 50%, the ruble's down 50%, upstream margins, given how they tax their crude, are actually up. You're actually making you're making better margins now in the upstream environment in Russia than you were making at $100 oil. North Sea, great candidate for getting hit in this low price environment, except for the fact it just isn't happening. I was in Norway last Monday, or this Monday, and Statoil up there convinced North Sea production will be up this year and next. Okay, lots of focus on Brazil, Petrobras. Even if they default, they're still going to grow. Okay, the rigs, they've been built, steel's been cut, 80% of the capex is done. There is Brazilian growth that is coming. There is Canadian growth that is coming. So this non-OPEC could get hit. So this is big oil capex. Okay. This big gray wedge here is the money that gets spent on brownfield maintenance. So big oil spends 40 to almost half its cash slowing decline rates in mature basins, and that's what's gotten cut the most. Okay, so this should accelerate decline rates in these mature basins. The problem is that as of right now, it's just not happening. We think it probably starts to happen next year, but it's not a foregone conclusion, because yes, okay, capex in this part of the expenditure is down 50-odd%, but services costs everywhere are down materially. So what's the actual per barrel impact? It's far from clear. Do we have the cost curve in there? All right, so what shale has done is, so before shale came along, we were in this world of ever-rising demand growth because there's so many people in India and China and they're all going to drive cars, yada, yada. So demand's going to go up forever and ever and ever. And supply, we just struggled to grow supply. So we didn't seem to, what was happening in the industry, here in the small type, I apologize, but that's the cost curve. Do we have a big one? No. That's the cost curve for the industry. Okay, so I would say that what was the mentality at the big oil companies was, don't even worry about the break even. Okay, don't worry about the cost, the price of oil, because it will accommodate you. Demand is going to go up forever and ever and ever. As a big oil company, you just have to go and find the barrels. You have to find the oil and the gas. You need something that's big enough to move the needle for an Exxon, for a Chevron. You need 100,000, 200,000 barrel a day project. Don't worry about the break-even price. So big oil made a big, is this thing point? There, no. All right, look, at the far right of the cost curve. Big oil made a very big home for itself at the far right of the cost curve. Your Canadian oil sands, your ultra-deepwater Africa, your Australian LNG, projects that need $100 oil for 15 years, and that's actually that's undercounting for some of these Australian LNG projects. And so big oil made a big home for itself at the far right of the cost curve, and then along comes shale, kind of right in the middle of the cost curve, in this 50 to 70, now it's like a $40 to $60 commodity. And it's potentially infinitely extendable in theory. Okay, we don't know how much it can be extended, but we know it can go a lot, and we know it can go an awful lot longer than most people were assuming 5-6 years ago. So it's really an existential threat to big oil's big old home at the far right of the cost curve. So that's sort of the disruptive nature of shale in this market. Because now I'd say that the market debate, previously the market was, we were in this all of the above world. We need it all. And don't worry about the break-evens, we just need it all. To now, I'd say the debate is actually, do we need any of that high-priced stuff? Like, that's really the question here. The reality is that if the Middle East fulfills its productive potential, if Iran gets its opening right and pulls in the $200 to $250 billion it needs, and Iraq manages to get through its geopolitical issues, and Saudi, the Saudis have sanctioned Sheba, 250,000 barrels a day, Kuwait's expansion, 300,000 barrels a day, UAE and Kuwait, they both want to grow roughly 1 million barrels a day. If they get their act together, then we don't really need any of that high-priced hydrocarbons. If they, for whatever reason, if they fail to achieve their productive potential, if Iran is too aggressive in its opening, and if the geopolitics intervenes, then we probably need some of it. That's the question now in the industry, is which of these do we need? But we certainly no longer need all of it. Okay, the one thing the Saudis can point to in terms of this strategy working is a lack of new projects getting sanctioned. Okay, that's the one thing. Okay, there's no sign as yet of non-OPEC production rolling over, but the two drivers of non-OPEC supply will be what happens to existing production, which is your capex on brownfield maintenance getting cut, but it's not having any impact yet, versus new stuff, because you will need to, there are decline rates, you do need to bring on new stuff. Okay, new stuff is not getting sanctioned in this environment. So the question for the industry is, now, you don't need to, there's a long lead time for projects. So stuff that was going to come on in 2015, in 2016, and probably even into 2017, it's in the bag. is that the growth is going to happen. But the question, do we hit an air pocket in 2018, 2019 on supply? That comes down to that Middle East question. If they get their act together and they really grow as fast as they certainly have the geologic potential to do so, then we can just stay low. If, on the other hand, it doesn't happen for whatever combination of reasons, then I think we do hit a bit of an air pocket on supply, and we need some of this high-cost oil. All right, so I did say I wanted to come back to this. This chart's so good, I used it twice. So because I think it explains an awful lot of what is going on here. So I said primary energy, oil, gas, and coal, exactly the same story as the oil. But the point is that you've got one short left in the world, and don't underestimate all this LNG that is now starting to point its way. We just started up the second LNG. There's 14 Australian LNG trains that will start up in 2015, 16, and 17. Okay, it's all heading to Asia. When the US starts exporting gas at the end of this year, some of it will go to Europe, in part to hurt Putin, and some of it will go to Latin America, but that will back out other volumes that will head to Asia. And as it does, you will see some of that gas substituting for oil. Singapore, a couple of months ago, just tendered for full LNG bunkering facilities for the entirety of Singapore's maritime facilities. If you've ever been to Singapore, you will know that there are an awful lot of ships in that port. It is a very, very active port. If you, Japan just announced a big push for kicking more gas into the transportation sector in Tokyo and Osaka. I was with a company last week that is working with the Nigerians because we now have cheap gas. Okay, we have cheap gas in Asia. Gas is, I think, about $6.70 now. Okay, that seems expensive versus U.S. pricing, but it's a lot cheaper than it was, given that it was $20 last winter in Asia. This lower oil price, which is supposed to prolong the age of oil, that's another plausible interpretation of the Saudi motivations, is actually trapping a lot of gas around the world. There's gas in Africa, there's a lot of gas in FSU that people had assumed was going into global LNG markets. The economics looked very compelling when gas was 15 to 20 bucks, 13 to 17, whatever the price assumptions was. Now gas is under 7 bucks. I was in Japan over the summer where they had an insane heat wave. It was revolting, and it was a heat wave across Japan and China. That took LNG briefly over $8, and it only lasted 2 weeks. Okay, and the wall of LNG is just starting to ramp up. So as this LNG price comes down, you are effectively not only, just like oil is cheap, so is gas, so this gas for oil substitution in Asia can continue, but you will also trap gas in a lot of countries around the world that people were targeting for LNG exports. It won't happen, and governments are just starting to think, what can we do with that gas? And one thing we will do with it is replace the oil. All right, I've got 5 minutes. So I wanted to close on, because I was in Texas last week, so I pulled this chart in here because you want to end on a bullish note in Texas. But I do also think it seems topical. It seems topical because I understand today at another part somewhere in the building, somewhere in DC, there's a debate about selling SPR barrels. Okay, so I think that's... my own personal view is that that's not obviously a very good idea because of the change in market structure that has happened here. Okay, what we have shifted from, if you guys used to follow oil, we used to think about oil as a call on OPEC. Okay, the way you used to think about oil analytically is you'd say, well, here's my demand number, and here's my non-OPEC supply number, and here's the plug that we need from OPEC. We need 30 million barrels, or we need 25 million barrels. And if they overproduce, it kind of looked a bit bearish, and if they underproduce, then it looked kind of bullish. Okay, well, now OPEC is basically saying, well, we don't do that anymore. We're not a plug. We're baseload. So now, if you try and think about oil balances over the next 5 years, you kind of have to come up with a call on shale. Okay, so what we do is you figure out, well, here's OPEC, they're going to keep ramping up, and here's our estimation for demand, and here's how much production we need from shale to plug that gap. And that shift has certainly, it's one of the key drivers for the lower oil price. So it's a really good thing, except that what it means is that OPEC was always viewed as having the ability to cover a shortfall. Okay, the Saudis keep a couple of million barrels a day of spare capacity. OPEC at various times has had a much bigger number than that in terms of spare capacity. Okay. Your shale players your EOGs, your pioneers, okay, they are never going to carry a big chunk. They're never going to just carry 1 million barrels a day or 2 million barrels a day of spare capacity. Okay, that's not going to happen. The world right now is an incredibly vibrant place. You have Russian airplanes and US airplanes flying around in Syria. You have Yemen. You have Libya. Okay, the Middle East is a mess. Russia is being as uncooperative or antagonistic or whatever, pick your phrase. So the geopolitical risk, I would say, is high and is materially underpriced by this market. One reason why people stay bearish is they say, look at these inventories. Look, inventories are so full right now. Okay, except for the fact that, and that's true, inventories are high, except if we no longer have a material basin of spare capacity, if we're not in a position, if something bad happens in Nigeria, if you can't turn to the Saudis and say we need 1 million barrels a day, we need an extra 1 million barrels a day of oil to plug the gap, then what are you going to do? Okay, so it is not only is what you do is you're sort of reducing your security buffer at exactly the time that you need it the most because geopolitical tensions are high. So my point is that I think that you need, given that OPEC spare capacity is basically zero except for whatever they have in Saudi Arabia, and a lot of that is crude that it's not very easy to process. Okay, everyone else is running absolutely flat out and will continue to do so. So you have a very low buffer of spare capacity at a time of high geopolitical tensions. Maybe you need to look at these inventories, including the SPRs, as the new alternative to the spare capacity that we used to assume that OPEC would carry on their balance sheet. And with that, I have 1 minute left, so I'll finish there. Do you have time? Do I do questions, or do I go? What do I do? Yeah, I'm happy to take any questions.
You sort of mentioned about the SPR point at the end, but there's a debate this week, I think, in Congress, or they're going to start looking at potentially oil exports from the U.S. So it doesn't look like from your presentation that it looks like the whole world is oversupplied, and so I don't know how effective that will be. But what's your opinion about U.S. potential oil exports?
Well, it's looking a lot likelier than it was looking, which look, if you move towards oil exports because of an ideological commitment towards free trade, then Godspeed, okay, because that's utterly defensible. And I'm sure that that's a component of the debate. I have a sneaking suspicion that some of the lobbying that has gone on pushing that debate is also because it's viewed as a big benefit for upstream players in the United States. Okay, and people were convinced of that it would be a good idea, that it would lower gasoline prices and it would help close this gap between Brent TI, the discount that TI would pick up. Everyone started thinking about that a couple of years ago. That was when we had a tight Atlantic basin. Okay, except now we have a glutted Atlantic basin with crude. And it's probably going to get more glutted. And now the US says, well, we want to start exporting crude. Well, all that would do is kick more crude into the Atlantic basin, which is already glutted. So you could, in theory, help WTI versus Brent, but you could hurt Brent more in the process, leaving WTI lower than it otherwise would have been had you not started to export that crude. I would also say that one of the arguments that people in Texas used to get very upset when you'd have these big blowouts between Brent and TI. That's what really drove the whole debate, other than obviously the ideological commitment to free trade. We don't get these blowouts anymore. Okay, that's not just a temporal phenomena. Right now, you have $2.50, $3 spread. So what is crude exports going to get you? Well, kind of nothing, because it's already a very tight spread, and TI would be under Brent anyways. But we showed in 2Q, up until 2Q of 2015, we'd get these big blowouts in WTI versus Brent because we would get full at Cushing. Okay? And when you got full at Cushing, then WTI would go into a steep contango, and that's what would push the spread between Brent and TI, the big discounts, the 8, 10, 15, I think 26 I think we peaked at. Okay, well, I don't think we have that anymore. In 2Q, we got full at Cushing, and what we found out is that over the past few years, those wide spreads, they were wide enough for long enough that we've built pipelines connecting Cushing to the East Coast, the West Coast, the Gulf Coast. It was a total non-event, this getting full at Cushing. So I don't know if we even get these seasonal blowouts in Brent WTI anymore. So from a free trade perspective, I think it's incredibly compelling. It's irrefutable. But in terms of achieving higher realized pricing in the United States, I sort of think proponents of the export removal ban should be careful what they wish for because they might get it. All right. Thank you very much.